Morning, everyone. Welcome to our Phillip Securities Research Morning Call. For today, we'll be going through the US and Singapore stock picks, which was held last week, as well as some technical analysis. So without further ado, I'll hand over time to Jonathan to talk about the US stock picks. Thank you.
Thanks.
Sorry. I'll go through the technicals first. Sorry. All right. So for S&P 500, last week we broke above this 4,450 swing high level. With that, if we do continue the uptrend momentum, we could possibly test 4,450, which is this uptrend channel resistance over here. As for the current resistance, likely to be between 4,005 to about 4,006 area, while the support is around 4,380 to about 4,440. As for our individual counters, the first one will be Citrum. So for this, we had technical buy at 12.7 cents with take profit levels at 13.8 cents and 14.8 cents, with a stop loss at 12.2 cents. The stop loss closed at 14.5 cents on Friday. So for Citrum, there was a breakout of this cup and handle formation over here, and the price actually broke above this 13.3 cents resistance level, and it hit the first resistance level, which was the swing highs back in February this year. And it could, if it does continue the bullish momentum, it could go on to hit the 14.8 cents next resistance level. The next one will be ISDN Holdings. So for this year, technical buy at 43.5 cents, take profit levels at 49 cents and 52 cents, with a stop loss at 41 cents. It last closed at 43.5 cents on Friday. So for ISDN, it has been consolidating in this triangle over here, and recently it has tested this double bottom around 42 cents over here and found some support, with also bullish divergence forming in the MACD. So with that, our share price could rebound to go and test the first resistance level at 49 cents, which was this the high of the high volume gap down day previously, and also 52 cents next, which will likely be the downtrend resistance line resistance level over here. The next one is Yangzijiang Shipbuilding. So for this, the technical buy at 152 with take profit at 170, stop loss 147. It last closed at 152 on Friday. So Yangzijiang is continuing on its current bullish momentum from the breakout above this uptrend channel, and after a consolidation in a bullish flag, it has broken out again. So with that, it could go on to hit to 170 when I take the height of this bullish flag, which is around 20 cents, and project it onto the breakout level 150. Also, MACD is also displaying positive momentum over here. Last one will be Genting Sing. So for this, is technical buy at 95.5 cents, take profit at 104, stop loss at 92.5 cents, stop loss goes at 95.5 cents on Friday. So for Genting, it has been consolidating in a descending wedge over here, and it managed to break out on Friday itself. There was also bullish divergence observed in both MACD and RSI. So if that, the stock could potentially rebound to go on to hit the 104 level, which was a previous horizontal resistance level back in May this year, as well as confirm with this downtrend resistance line over here. So that's all from me now. I'll pass on time to John to talk about our US stock picks.
Thanks, Zane. Good morning, everyone. So we'll just jump straight into the stock hunters that we actually covered during our third quarter strategy and stock picks for the US market on Thursday night. So the first counter you're talking about is Alphabet Inc. Next slide, please. Okay, great. Yeah, so for Alphabet, the main thing that we're actually seeing that we're bullish about is the resilience in its search ad revenue. In case you didn't know, most of revenue that Alphabet actually generates is from advertising. Of course, they do have their hardware, pixels, and they also do have cloud, but the main growth driver comes from advertising. And what we're seeing right now is that we're seeing some sort of resilience and stabilization in ad revenue growth. The chart on the left, you see like right here, ad revenue growth has been coming down from the second quarter in 2021. It's just been declining or rather it's been contracting all the way until the fourth quarter of last year. And what we're seeing right now is some sort of stabilization, which actually, in terms of the overall macro industry for digital advertising, we do expect some sort of leveling off and maybe a general recovery, a gradual recovery over time. And so for Alphabet, what we think is that a lot of the negativity in terms of ad revenue is more or less over. And so we should be able to see some sort of pickup in terms of overall growth moving forward. The second point is that they have actually focused quite significantly on improving its cost structure. So they've laid off about 5 or 6% of their workforce. They've also consolidated a lot of office facilities and reduced a lot of their capex. In terms of our own forecast, we actually reduced 2023 estimated capex by about 17%. So it's quite a significant reduction in terms of expenditure, and this should help margins recover a little bit. The last point that we have is that we think that AI, is going to continue to drive some sort of efficiency. So it's a combination of AI as well as automation. It's going to drive efficiency in terms of your daily operations for Alphabet. AI, I guess to a larger extent, will also help increase efficiency in terms of their products, delivering higher ROI for advertisers. And this is a positive because if you deliver a superior product, generally you're going to be able to charge a higher fee. And the benefit for Alphabet is that because a lot of the costs are relatively fixed in nature, so whatever additional revenue that you can generate is just just incremental to margins. Another point is that cloud, which is Google Cloud, turned profitable for the first quarter ever in the first quarter of 2023. And so we do think that cloud will and the reason for this is mainly because they've reached scale. And so over the last few years, they've been investing quite heavily in terms of their data centers to support cloud services. And now, once they've reached this certain scale, every additional revenue that they earn will be able to drive some sort of positive margin accretion for the company. In terms of our rating for Alphabet, we still maintain a buy with a target price of $131. So moving on to our next counter, which will be Meta. We think that for Meta, everybody knows that they cut quite a lot of employees. In fact, they cut almost 30% of their employees. So essentially, one in every three persons is gone right now. So it's a significant reduction in terms of employee costs. And secondly, we do think that margin recovery will continue, but we are not sure if it'll move back to pre-pandemic levels of like 30+% margins. And this is mainly because they are still spending quite a lot of money in improving their platform. They're also spending a little bit of money into their metaverse. So you can see in the chart, prior to 2022, most of their net margins for each year has been above 30%, excluding 2019. And this is mainly because they got hit with a large $5 billion fine in Europe. So this impacted their margins quite significantly. But you can see 2022 margins dropped by more than 50%, mainly due to reduction in digital advertising spend, while the company was still spending more money on capex and so on, and hiring and all that. One thing that we think would be beneficial long term, but in the near term it's kind of a drag, is the company's shift to short form video platform Reels. So they've been moving away from their static feed to this short form video kind of format. And this kind of provides a short-term drag on margins because Reels actually has a significantly lower monetization rate compared to your static feed. Like if you're just scrolling through Instagram on their normal page, you're going to be able to see a lot of advertisements and it's quite in your face. Whereas if you move on to Reels, there's very limited opportunity for ad placements. At the same time, a lot of companies don't really have the capabilities to create ads, that can fit your 5 to 10 second frame. And because advertising pricing works on a supply and demand kind of mechanism, right now, your demand is relatively low compared to your static feed advertising rates. And so as right now, because there are not as many people that are on Reels compared to your usual feed, we think that it's definitely a drag. But as more and more people start to come onto the platform, start to be more, I guess, as Reels start to be a little bit more popular, then we'll start to see a little bit of shift in the longer term in terms of monetization rates for Reels. In terms of digital advertising headwinds, we think that it's still present. There's also a lot of competition from other big players like TikTok as well as Google, Alphabet. And so we do think that this tough competition, and mind you, Meta is a little bit different from Alphabet because they are really only, most of their revenue, 90+% is really only advertising. So they don't really have any other revenue drivers at the moment. So we remain neutral on Meta, mainly because the share price has really shot up quite significantly, with a target price of $235 US. Moving on to my next counter, which is Netflix. So Netflix, we expect their margin expansion to be gradual. The company has actually implemented two new services or two new products. The first is their ad-supported service, which essentially is half the price of a regular standard plan. But it incorporates more ads, and ads are generally higher margin. Each ad is like 70 to 80% margin. And so what we think is that as more and more people start choosing the lower priced ad supported plans, it's only going to be incremental to revenue and to margins. Right now, what we're seeing for ad supported plans is that there are around 5 million monthly active users over about 6 months of the plan being introduced. And it's quite significant because the ad supported plan isn't even introduced to a lot of countries worldwide. So it's predominantly right now only in the US. And so something in the terms of long run, we think that this is going to be very beneficial to margin expansion for the company. In terms of their other product, which is a crackdown on password sharing, so we think that this, I guess, it's only incremental because if you're going to make it a little bit more difficult for users to share their passwords outside of a single household, you would naturally get some users that have been sharing, and they're like, okay, maybe I'll just start subscribing to the cheaper ad supported plan, which is about $7 or $8 US. And so this really it's quite a big deal for the company because Netflix estimates that about 100 million users, or about half its users, or almost about half its users, are actually sharing passwords. So there's a lot of revenue leakage there. And so what the company is trying to do is to at least claw back a little bit of revenue from these people that are sharing. And the initial results are actually quite promising. And there's quite a number of signups, new signups that used to share passwords, and so that's been quite beneficial for the company so far. Secondly, we do also expect the streaming market to continue providing tailwinds for Netflix because they are the predominant player in this industry. Streaming just has so much more benefits compared to traditional cable or broadcast TV. It's you can watch it on the go. There's a little bit more variety, and it's significantly cheaper. At about $15 to $20 a month, compared to if you had cable TV, which is like 50 plus per month. There's significant savings there for a lot of people. Lastly, we do think that, actually what we're seeing is that the majority of membership growth is actually coming from the APAC region. So growth, is a good thing, but because a lot of it comes from APAC, which has lower monetization rates, it does have an impact on ARPU, which is your average revenue per user. And so if we, as we continue to see growth in numbers coming from APAC, we would expect ARPU to continue declining, at least until there's some sort of maturation in a lot of these APAC countries where we're able to at least start raising prices to be a bit more comparable to developed regions like Europe and the US. We maintain neutral on Netflix with a target price of $388. Similar to Meta, Netflix has seen quite a significant expansion in their stock price, and that's one of the reasons why we actually downgraded it to a neutral rating. So with that, I'm done with my counters. I'll hand it over to Max to continue with Apple. Thank you.
Yeah, thanks, John. So firstly, for Apple is that the growing service revenue, we believe, is going to contribute positively to the company's overall margins. And this is because the services segment has a gross margin which is much higher at 70% compared to the 30% of that when the company sells their hardware products such as your iPhone, iPad, and your Macs. And then furthermore, we also like the services segment because it is recurring in nature because majority of this is based on subscription, and it will also scale as the number of iPhone users or Apple device users increases as well. So it's not limited to the number of how many iPhones that Apple can sell in a year. And then for the second point is that we are not expecting a material financial impact from the Vision Pro. So just as a background, Vision Pro is AR VR headset that Apple announced a couple of weeks ago, and it will be available in the beginning of 2024 at a price of $3,500. So we are not expecting a significant revenue contribution from this device, mainly because we believe there will only be a limited small number of customers who are willing to buy the device given the high price tag. And because of this, we think that instead of being a revenue growth driver, we believe the launch is intended to establish a stronger supply chain as well as pool of developers so that they can enhance the user experience for the subsequent generations of their products. And then for the third point is that we are expecting a negative growth for the remainder of the financial year. And this is because we believe right now most likely the customers are going to just wait, defer the iPhone purchase and wait for the expected iPhone 15 release in September. And as a result, this will create a pent-up demand, and therefore we believe the revenue growth will re-accelerate in FY24 next year. So because of the limited near-term upside, we maintain our neutral rating on Apple at a target price of $183. Next slide, please. Now moving on to Amazon. So first point for Amazon is that its AWS cloud computing segment is going to benefit from the generative AI adoption. And just as a side note, this is not specifically to AWS, it benefits all the other cloud service providers as well. So specifically for AWS, they have just released 2 new AI tools, and because currently all of the customers of AWS has already placed all of the data into their servers, we think they're going to face a high switching cost if they choose to switch to another provider. So because of this, we believe more often than not, they're just going to opt for AWS new AI tools, and this should create an opportunity for them to increase their spending with the company. And then for the second point is that we are seeing increasing improvements in efficiency for Amazon, and as evidenced by the fact that its average revenue per employee has increased by 20% in the first quarter of last year, as you can see from the chart on the left. And then furthermore, recently they have also overhauled their delivery network such that they want to minimize the distance traveled by their products, which in turn will reduce the shipping costs because longer deliveries cost much more. And both of these factors combined should be able to expand the company's margins for the retail segment. However, for the third point, we are seeing limited growth headroom for this year. And this is because inflation is still high, so customers are still wary about their discretionary spending, which will pose as a headwind for the retail segment. And secondly, Amazon is also guiding for growth deceleration for its AWS cloud computing segment. And we are also not sure when their customers are going to stop their cloud spending optimization efforts. So yeah, because of this, we don't see any. We're not expecting any significant surprise to the upside and for this year. So overall, we maintain neutral on Amazon at a target price of $120. Next slide. Yeah, so moving on to my next counter is NVIDIA. So first point for NVIDIA is that we're expecting a very strong second half of this year, and this is because NVIDIA itself has already guided for a very strong revenue growth for the second quarter. And then this is not surprising because GPU is the main component enabling the generative AI technology. And NVIDIA has, at the beginning of the year, has just released their latest generation of data center GPU, which is the H100, that was designed specifically to handle the large language models that are powering the current generative AI technology, such as your ChatGPT. So it really coincides with the launch and the trend on the market. And then secondly is that we're also expecting the margins to expand because NVIDIA benefits from the higher average selling price. So as NVIDIA sells more of its data center GPUs, which is the H100, it's going to benefit the company because we believe H100 costs about 200% more than its previous generation. So as more customers buy this, they are going to benefit from the higher selling price. And then aside from that, for the consumer side, they have also recently just released their RTX 40 series consumer GPUs. And these GPUs are also about 20% higher, cost about 20% higher than that of the previous generation. So overall, across their product portfolio, they experience a price bump, and this will also provide opportunity to expand their margins. However, for thirdly, there's a recent news that the US government is considering to post additional curbs on AI exports to China, and 20% of NVIDIA's revenue comes from the Chinese customers. And because of the news, the CFO has already came out and said that if the government decided to post additional curb, it will hurt the Chinese business entirely. But however, they're not expecting the effect to be immediate, and we believe NVIDIA will just create another model that is of lower spec to meet the export demand, to export requirements, which is what they did last year when the first export rules were introduced. So overall, we still maintain our accumulated rating on NVIDIA at a target price of $440. Then moving on to my last counter, which is AMD. We have just initiated the coverage on them, and these are some of the highlights. So firstly is that we are seeing tailwind for AMD from generative AI. And this is because generative AI will require even more computing space, which will result in increasing demand for servers. And this will ultimately benefit AMD because this means the market will need more CPUs from them. And furthermore, we believe that AMD will be able to increase their market share in the data center CPU market, mainly because more workloads are being migrated over to AMD powered systems. And however, they are still underrepresented in the data center GPU market with only about 8% market share. But we believe that despite this, the company will be able to increase its share there, as we expect the customers to look for a second source of supplier so that they can reduce their reliance on the largest player there. And then for the second highlight is that we are seeing some potential for margin expansion for AMD. So, and this is particularly because AMD is selling more of its data center and embedded products which have higher margins. And particularly for its data center business, they have just released their server CPUs, the latest generation of server CPUs at the end of last year. And this latest generation has about 50% higher average selling price compared to the previous generation. So again, as more customers buy these new latest CPUs, they are going to benefit from the increasing selling price, and therefore it should expand their margins as well. And then lastly, same thing as NVIDIA, they are also facing the threat from the US-China tension. And although AMD doesn't disclose how much revenue comes from the Chinese market, 70% of their total sales come from the international market. And we expect that China makes up quite a meaningful portion of that number. So yeah, if any additional export curbs from the US government is going to threaten the ability for AMD to sell their chips to China as well. So overall, we have an accumulated rating on AMD at a target price of $125. And yeah, that's all my counters. I hand over to Ambrish to run through his. Thank you.
Thank you, Max, and good morning, everyone. So moving on to Microsoft, we believe that there are two main growth drivers. First of all, the Azure, the momentum is still strong in its cloud service Azure. So it's the fastest growing segment for Azure, Microsoft, as well as we believe that it's gaining market share from its competitors like AWS and Google Cloud, mainly because it's fastest growing as compared to them. For the June ended quarter, Azure revenue is expected to grow by about 26% year on year, while AWS is expected to grow by about 15%. So the growth rates, they are slowing down, moderating as compared to the previous quarters, and we believe that this is mainly because of the macroeconomic uncertainty as the companies they pause their IT spending. So moving on to our second thesis for Microsoft, there is continued demand for Office 365 productivity software. So my Office 365, it basically includes its Word, Excel, PowerPoint, Teams software, and it has a market share of about 90% in the global productivity software market. We believe the main growth drivers for this Office 365 is that mainly because of continued product enhancements, as well as the demand is coming from small and medium enterprises, and this is mainly because of rising need to manage tasks and workflows. So we believe that the generative AI integration into its Office 365 should enhance the demand for this particular software. So like the AI integration into its PowerPoint, it could generate the first draft of your PowerPoint slides, whereas into Word, it can generate a text or summarize a particular paragraph or whatever you need from that. So we believe that the AI should boost its demand. And lastly, there has been a weak consumer PC sales demand, and as a result, it would impact its Windows OEM revenue. So Windows OEM revenue, it's expected to decline by about 20% in the June ended quarter. And this particular revenue Microsoft generates from the PC manufacturers like Dell or Intel who install Windows operating software on their machines. Lastly, Microsoft, it is looking forward to close its acquisition Blizzard merger deal this week. However, it's still under the negotiating terms with the UK's antitrust authority. Mainly because we believe that the deal should go forward mainly because Microsoft, it's not planning to withhold any content, acquisitions content for its own platform. However, it's looking forward to sign a particular deals like in the past, it signed a 10-year deal with Nintendo that it would offer Call of Duty on their platforms as well. So overall, we have a neutral recommendation for Microsoft with a target price of $328. And this is mainly because of the recent share price run up. Next slide, please. So moving on to my second counter pick, which is Airbnb. We believe that the travel demand is still healthy. So like if you look at the chart on the right hand side, in FY22, the bookings volume, they already surpassed pre-pandemic levels. And we expect the volumes to surge by about 15% CAGR over the next 2 years. This is mainly because of urban and cross-border travel recovery after the COVID-19 restrictions they have eased. And also stays of 28 days or more have remained resilient, and they contribute about 17 to 18% of the overall booking volumes. And this is mainly because of the flexibility granted by the remote work environment. So secondly, the Airbnb's business is getting more profitable. Like in previous year, it has reported a maiden net profit of $2 billion, and this is expected to grow going forward mainly because of its top line growth as well as high operating leverage. Secondly, the unique supply on Airbnb's platform, it has been increasing consistently. Like the total active listings on Airbnb's platform as of March, they were like 7.6 million, and compared to 7 million as compared to the December 2022. And this is mainly because the continuous product enhancements as well as Airbnb's support to hosts. Like it had recently introduced Airbnb setup as well as Ask a Superhost. So these continuous enhancements, they help hosts, they get confidence to list their properties on the Airbnb's platform. And in terms of the third point, rental rates basically means the average daily rates that the hosts charge. They are expected to be remain under pressure going forward in the 2023, mainly because of the business mix shift towards the urban and Asia Pacific regions, mainly because they have lower rental rates because of the smaller room sizes as compared to the non-urban locations. So, however, for Airbnb, we have a buy recommendation and a target price of 143, mainly because we believe that it should benefit from the shift to alternative accommodations. And also they are more family and group friendly. Next slide, please. So moving on to my next counter stock pick, it's Salesforce. So we have the title Continued Margin Expansion. Salesforce, it's basically a cloud-based software company, and it has a software as a service business model, and as a result, it generates most of its 90% of its revenues through subscriptions. And the two main co-products for Salesforce are its Sales Cloud as well as Service Cloud, and they basically help companies to automate and manage their sales operations as well as to enhance their customer relationships. So the first thesis for Salesforce is that there is continued demand for its Customer 360 platform. So Customer 360 platform, what it does, it integrates its various products, and basically it integrates its various segments like sales, service, marketing, or IT into a comprehensive platform where the enterprise, they can get the holistic view of their customer information. Like for example, a service agent, it will automatically get information about the previous sales data that the customer has, when and which product it had purchased previously. So there's been continuous demand for this particular product. Secondly, it expects its margin to increase, like its adjusted operating margin to increase from 23% in FY23 to FY24, 28% in FY24. And this is mainly because of its cost-cutting initiatives. Like earlier this year, it had laid off about 10% of its workforce. And just as a note, adjusted operating margin, it basically excludes its non-cash expenses like stock-based compensation and the one-offs like restructuring expenses. So moving on to our third thesis, that Salesforce, it has integrated AI into its most of its products like Sales Cloud. It basically helps salesperson to compose sales email as well as to schedule meetings. And for Service Cloud, it helps like to auto-generate personalized chat replies. So it's expected to benefit from these generative AI tools. And also last week, Salesforce, it had mentioned that it's going to increase its pricing by about 9% for most of its product from August. And this is after the price hike comes after almost 7 years. So we believe that this should provide a tailwind to its top line, mainly whenever a particular renewal happens, or any customer purchases a new product, they would be getting more revenue as compared to earlier. So overall, we have an accumulated recommendation for Salesforce with a target price of $226. So that's all for me. I would now like to pass on to Paul for Singapore strategy and stock picks. Thank you.
Yeah, thanks, Ambrish. So we'll just run through some of the stock picks. It's customary for us after our usual quarterly strategy. We'll just give a summary for the meeting. So apologize if some of you have already heard this, but for this session, we're just going to run through some of the stock picks. So for me, will be ThaiBev. So just three key points for me will be, firstly, will be the valuations. So if you look at this chart, share price is trading at pandemic valuations in terms of PE around 12 times, or even in terms of the share price is also trading at pandemic levels. The valuations at 12 times is actually even lower than some of the Thai consumer names, which is about 20 over times. The second thing is that some of the reasons why the share price is so weak is mainly because of news that a new administration or the opposition party may introduce a new alcohol bill. There are positives and negatives to it. I mean, the negative is that it will open up the alcohol industry, and it will allow smaller players to enter. And this is important because ThaiBev's spirits business, which is the sugarcane rum business, which is like almost 80% of the profits, they have a 90% market share. But we don't see this as a threat, since ThaiBev has such an entrenched distribution network with almost 400,000 points of sales. There are also positives to this bill, which is namely, they will allow for longer operating hours, actually only 2 more extra hours that you can sell alcohol. At the same time, you can sell it online. My final point for ThaiBev is that there is some risk. I think the risk is, of course, all political. the biggest risk is that if there is protest and there's violence, then it would obviously derate not just ThaiBev, but the whole Thai market. This is not our base case assumption, but there's always that risk. I guess the only feedback is that if there is some violence, I guess the military has learned ways to cope with this, because there have been so many protests in Bangkok. But there is the tail risk that I think any investor that's taking on if they were to enter this stock. Next slide. Yes, of course, yeah, ComfortDelGro, we still like it, mainly because if the outlook is still positive, if it's not, we wouldn't have still recommended it. So there's again another 3 key points. Firstly, the taxi, we expect taxi to perform better, mainly there's pricing power. I think we saw the news, they raised the platform fee. They also reduced the taxi rebate, which is the discounts they give to taxi drivers, from 15 to 10%. And then year on year, you also get the benefit because they also raised the commission from 4 to 5% on the taxi app, the Zik app. So that's the first point. The second one would be bus. Bus can recover, but will be a bit slower because last year they actually recontracted some Singapore bus contracts at a lower price, so that will hurt them. But at the same time, they were going to get repricing in the UK. So it's a mixed bag for bus, just that it will be slowly creeping up. The final one for rail, you will recover because passenger traffic is moving at high teens. The chart here is, sorry, I forgot to mention, just that on the first point regarding taxi, is that the fleet continues to stabilize. So you will notice on 2017 to, almost 2020, 2021, the fleet continues to shrink very sharply because of the, of course, of the introduction of ride-hailing apps. But since then, it has started to stabilize. Next slide. But next one will be Propnex. I didn't really change much because there's nothing really has moved materially. What we do think is that maybe the number of transactions might come off a little bit because the high end may not be able to see much sales because of the 60%. But for me, the main 2 points. First point will be the dividend yield. We think it's still attractive at 7%. This is paid off from 50 million of dividends which they generate from their ordinary cash flow, and they have another 150 million of cash in the balance sheet. The main thing on dividend is that the management continues to intend to keep the number of intend to keep this stock as a high dividend stock. Yeah, so I think they are willing to give attractive payouts. I think that's the one difference. The second thing is the volumes. So if you look at the line chart here, which is the red line here, the primary, which is the primary and secondary of private residence, we still expect a rebound in volumes, mainly because last year there was about 4,000 launches. Expectations was about 11,000 for this year, almost triple, but I think maybe you can shift that up to maybe around 10,000. But regardless, the number of new launches will still be double of last year, and volumes, of course, transacted will be the primary beneficiary for them. I think that's it for me. I will hand it over to Glenn to talk about the banks.
Okay, thanks, Paul. So for the banks, we chose OCBC over its peers. I think the main reason, okay, let me go about the similarities first between the three banks. So all three banks are looking to see their NIMs stagnate over the next few quarters due to the sort of the appeal of the high interest rate environment falling off. And however, we do see that for the three banks, they will sort of have a growth driver from their fee income recovery. And this is to fight off the declining loans growth for the banks. But why did we choose OCBC? And that's the main question I'd like to answer. And the main difference that OCBC has that sets themselves aside from the other two banks would be that they have an extremely high CET1 level. So CET1, for those who don't know what it stands for Common Equity Tier 1. And this is basically the highest quality capital within the bank's capital structure. And it's the most reliable as well as the most reliable loss absorbing component of the bank. And it's a good ratio to indicate whether a bank is financially stable. So usually a higher CET1 means that they are more stable, and a lower vice versa. However, when it gets too high, it can also show one thing, which is that the bank is not utilizing its excess capital well, and they should be either doing two things, which is doing acquisitions or paying out more dividends. So for the other two banks like DBS and UOB, they have utilized their excess capital well by acquiring the Citibank assets. However, and they also increased their dividends. And for OCBC, they have not acquired any sort of big things over the last couple of years, and they have however increased their dividends, but it's still, their CET1 is still the highest amongst the three banks. I think the last quarter was at 15.9% compared to the other two, which is below 15%. So we do expect that with no sort of acquisitions in the near future, they should be able to increase their dividends further. And even now, before increasing their dividends further, their dividend yield is the highest really among the three banks at 5.5%. And the other two are just below 5%. Yeah, so that's the main selling point for OCBC, where we do expect that their dividend yield will continue to increase. We maintain a buy rating on OCBC with a TP of $14.96. So now moving on to SGX. Yeah, our SGX. So SGX is our next pick. And SGX, you might be worried that there will be their volumes are moderating, as you can see from the market statistics that I put out in my banking monthly report. And both their derivatives and their equities are sort of stagnating. So, but we do see that their treasury income will sort of recover maybe even more than threefold going into the full year of 2023. And we look at their collateral balances, and it has also been steadily increasing. And this collateral balances is mainly the margin deposits which they hold, and they are able to use this collateral balances and put it into fixed deposits to earn interest. So just for some context, their collateral balances currently is at around, just sitting below, I think, $14 billion. So, when the interest rates are low, they will earn very low interest rates, which is what happened in 2021 and 2022. And when interest rates are high, like in 2020, they would be able to earn higher interest rates, higher interest. However, in 2020, just for some perspective, the interest rates, the Fed rate was around 2.5%, and currently it's sitting around 5%. So we could possibly see the treasury interest income more than triple in the full year of 2023. It's already about 50% above the full year 22. That's for the first half only. So this could add maybe around 10 to 20 percentage points to their earnings. We maintain a buy on SGX with a target price of $11.71. So that's all I have for the banks. I'll now hand it over to Darren. Thank you.
Thanks, Glenn. Yeah, so for CapitaLand and Ascott Trust, we like the story of the recovery in tourism. So as you can see in this chart, the RevPAR has been growing steadily since COVID, the lows in COVID. And right now in the first quarter of 23, you see that there is a it went down for the fourth quarter. Yeah, that's mainly because of seasonality. And you can see year on year, it's about up almost double. And so for Ascott, we think the RevPAR growth can come from China and Vietnam, because currently these two markets are still lagging, and it's still not yet not recovered to pre-COVID levels yet. The other markets that CapitaLand and Ascott are in, like Singapore, UK, US, Japan, the average daily rates of all the hotel rooms that they have are already all above pre-COVID levels. So the growth for RevPAR going forward for those countries will likely be from the growth in occupancy rather than the increase in average daily rates. But for China and Vietnam, is for both ADRs and occupancy, we see growth there. So another reason why is that we think Ascott is a good recovery place, because in the pre-COVID era, or rather historically, about 8% of the revenue comes from China, and last year only 2%. So there's still only 2% came from China. So, and for Vietnam, historically is 9%, but last year was only 5%. So we see there's some growth there as well. The international flight capacity to and from China also, it hit a post-pandemic high of 50% in July 2023, sorry. It's up from 10% in January at the start of the year. So you can see over the course of the first half of the year, the flight capacity to and from China has really increased by almost 5 times, from 10% to 50% of pre-COVID levels. So all this will help in the recovery of the tourism for Ascott. And another reason is that right now they have about 300 million in divestment gains that they have yet to distribute. So this can help to, should they distribute in the coming quarters, this will help to increase their DPU even further. They also could use this to acquire more, like they have a strategy of they have a target of 25 to 30% in kind of stable recurring income or longer stay accommodation. So yeah, they could use this 300 million to fund these acquisitions if there are any good opportunities in the market. Yeah, so with that, we have a buy rating on Ascott. And yes, a estimated DPU yield, FY23 DPU yield of 5.8%. Yeah, so next is Frasers Centrepoint Trust. For FCT, we like the story because they are very stable operating metrics, as you can see in the title. Their occupancy the portfolio occupancy for the retail side hit a high of 99.2%. So this is like all-time high 99.2%. So this was helped by the backfilling of the anchor cinema space at Century Square in the previous quarter. So Film Guard, they left Century Square last year, and Cathay will now set up their cinema space with 6 cinemas inside Century Square. So this help to boost the occupancy to the all-time high level of 99.2%. Yeah, other than that, their tenant sales trend has also remained around 5 to 15% of pre-COVID levels, and we think it will remain around like this, around the similar levels going forward in the next year. But we note that we do see a bit of a slowdown in the retail spend, but we think because FCT is suburban malls and a lot of it, the services are in essential services, so we think that the tenant sales will remain around these levels going forward. And they also have secured refinancing for all of their expiring loans this year. So we do not see any risk or any other than the higher interest rates, we do not see any refinancing risk for FCT in the next year. And their occupancy cost is also at all-time lows. Occupancy cost meaning the rental that you pay over the tenant sales. So right now it's at 15%. COVID it hit 20%, and its historical average before COVID was around 17.5, 17.2%. So right now it's low. So this gives the FCT the opportunity to kind of increase the rents back to maybe 17% or back to the usual occupancy cost, the normal occupancy cost of 17%. Yeah, so because of all these reasons, we do note that the high interest rate will kind of cap the DPU upside for FCT as well as the other REITs, because you have to pay more rents. You basically pay more in interest. You can pay less in dividends. So we do not think there's a lot of capital appreciation, but it's a really stable play with a stable dividend yield of 5.6%. That's why we like FCT. Yeah, moving on to CDL. So city developments, we note that they are hit hard by the cooling measures. The one that was in April 2022, the one where they increased the ABSD for foreigners from 30 to 60%. So that was really targeting foreigners and not so much the first-time homeowners. So as a result of that, their luxury product launch, which was Newport Residences, it got delayed. It was supposed to launch towards the end of April, but then just a few days before the scheduled launch, the cooling measures were announced. So because of that, they delayed it. And they have another launch called The Mist, targeting more of the mid-tier first-time home owners, the target segment. So that one continued to launch. Just launched earlier, or rather last month, and the take-up rate was 27%. Yeah, so we do know that even though the development segment for them is kind of slowing because of all these cooling measures and whatnot, but the hospitality segment is still doing quite good. Same as Ascott, their RevPAR is increasing and potential to grow even further. Like year on year for the first quarter is up 65%. So the growth is in this hospitality sector, and Another positive for them is that they acquired a St. Catherine Docks, which is an asset in UK, a commercial property in UK. So that after the acquisition, right now they have about £1 billion in of assets in UK. So they can monetize this by making it to a REIT structure, REIT structure. They tried to do that last year, but it fell through because it wasn't a good market to raise funds at that point in time. So yeah, if there's any potential, they could REIT this 1 billion of commercial assets in the UK. They also are pivoting more towards recurring income with the PBSA acquisitions as well as the private rented sector, where they develop properties to rent out rather than develop to sell. Yeah, so these are some of the reasons why we like CDL. And one more thing is that right now they're trading at about 50% discount to our RNAV of $15. So its book value is about 10, but our RNAV of $15 so is trading about over 50%. So we think that it is cheap compared to historical historical valuation that it's been trading at. So with that, we have accumulated with a target price of $8.33, which is that is about 45% discount to our RNAV. Yeah, next slide, please. Yeah, so for CLI, we like them because of their recurring income streams. Like they have FRB, which is the free related business where they collect management fees from their listed and unlisted platforms, as well as their lodging management and property management. So their listed platforms are like from Ascott, CapitaLand, Ascott, Sanders, etc., and their private funds. So they also will collect fees if there are any event-driven fees. For example, like any acquisitions or the investment, they will collect a fee from that. But then right now, because of the higher interest rate, is challenging for them to do so many of these acquisitions or divestments, because there are not many buyers out there who want to borrow at this high interest rate. So that there are lesser transactions out there, but we think you'll pick up in the second half. Like last year, there were not many transactions at all, but we still think we'll pick up as there's more clarity to the interest rates going forward. And in the orange bar, that's the real estate investment business. That's the other side of the business where they manage, where they own the assets themselves. So both segments, like the FRB, where it's more recurring fee income, and we project it to improve. But like I mentioned, the high interest rates will continue to affect them, and it is harder for them to raise funds as well because of this high interest rate. But we hope that there will be some recovery in China, as previously about 30% of their income comes from China. But in the most recent quarter, only about 10 to 15%. Yeah, so with that, we have a cumulative rating on CLI and with a target price of $4.12. Yeah, that's all for me. I'll hand over time to Peggy. Thanks.
Thank you, Darren. Thank you. I'll talk about Keppel Corp, which is in our absolute 10, absolute 10 stock pick. Okay, Keppel, why we like them is because the change in the model. They're progressively changing themselves, converting themselves from being an asset owner to become a manager. Keppel, two keywords we need to remember. Just need to remember for Keppel. One is asset monetization. The other one is asset management. Okay, the Keppel has set a target to monetize the assets up to 10 billion cumulative by the end of 2026 of assets that they want to sell. Okay, so like Paul said, they have a lot of furniture to sell. Okay, so up to now they already done 5 billion, so there's enough 5 to 7 billion to divest by the end of 2026, which will bring in the cash flow for them. Okay, and for the other part about asset management, they had a target of 100 billion Sing dollars AUM by 2026 as well, and 200 billion AUM by 2030. They want to convert themselves to become managers so that they earn recurring fee income and also maintain an asset-light model, so which will improve their balance sheet. What they you recall in February they had done was to spin off their KOM to C-Stream, now known as C-Stream, and that they generate 3.3 billion of profit, which they recognize in first quarter. So this first half results, which will also include this 3.3 billion non-recurring profit. So it looks very good. They look very good for the first half numbers coming through on the 27th of this month. For the asset management pie over here, 38% of our RNAV estimates. This includes all the stakes in the 5 listed REITs, as well as the assets that they could potentially sell, like Dynamac, their stake in Dynamac. They also have Chinese industrial parks, and they have a legacy assets which they have spin off that could bring back, which they have not collected the cash flow. That if the legacy REIT assets are sold by the buyer that I bought from them, then they potentially can collect back the 4.4 billion cash for this. So therefore, the balance sheet can improve. But if you look at our RNV estimates, a part of their value actually comes from the land bank, and about out of this 45% of this pie, almost half of that came land in China. These are residential as well as some commercial, and they have been seeing some improvement in land sales, in residential sales in first quarter. Second quarter, we expect that to have some more gains from there. So this portion will give them the pop in earnings every year. It's not recurring, therefore they know that it's not sustainable. They will be relying more on the asset management portion to give them the cash flow and the profits. So for this, we have a target price of $7.01. This just based on the value of the land, without the development potential. Unlike what you see in the market right now, where other analysts have projected development potential into the target price. Therefore, you see a very higher target price number. So therefore, we choose to be more conservative. We think most of the time they just sell away the land as land, or they form a joint venture with holding a minority stakes for the development of this land. So therefore, I don't factor in the development potential. That's all I have for Keppel Corp. I mean, maybe move on to the recent initiations. I wrote this report in late June. I had a reduced call at that time when the price was about 750, 740, 750. Why the target price of 680? This is because this is a 12-month target price, and in early August, the shareholders will get a 28 cents dividend. Will be paid as 28 cents dividend. By then, we think we expect the share price to correct for this dividend. Therefore, the trending low, nearer to our target price. Why the reduced call is because very obviously we know we see Cathay Pacific announced last Friday the amount of capacity that they had put back in, and the amount of volume of passengers that they have been able to bring back to their system. And same thing for the China Airlines too. We think though there are international flights out, international flights by the China carriers are just now about 15 to 20% of the pre-pandemic level, but we think over time they will bring it back very quickly into the system that will drive the passenger yields down for Singapore Airlines. So the days of the cutthroat airfare will be over quite soon. Yeah, there's some people might be cheering that too, also the thing is the pent-up demand so far. If you look at the breakdown of the travelers coming to Singapore, just as a rough guide, you see a lot of them are actually short haul routes, short haul travelers, and ground checks is most of these are coming via the budget air carriers. So the budget carriers while the yields are lower, the costs are also, I mean, confuse you. The margins for budget carriers are not as high as a full-fledged full carriers. So and cargo side, on the cargo side, it's industry-wide that the cargo volume has declined by double digit for first 5 months of this year. So that is also mainly because of the decline in the manufacturing output in the major manufacturing hubs. So cargos, the picture for cargo is not so rosy going forward, and therefore our reduced call for Singapore Airlines. Okay, move on to sets. Just carrying on from what I described about the short haul routes and the budget carriers. The sets, 80 to 85% of the passenger that pass through the Singapore airports sets will have some share of their business, whether to collect their baggage or to give them the food on the plane and so on. But for the short haul routes, if they are not Singapore Airlines flights, if say it's a Thai Airways flights, for the short haul routes, the food, they will collect the food from Bangkok, say Bangkok to Singapore flight, they collect the food from Bangkok. Then on the flight back from Singapore to Bangkok, the passengers eat the same food, right? So therefore, sets don't enjoy this kind of we call it double catering, where they don't prepare the foods for this kind of short haul flights. And of course, like budget carriers, you don't get to eat, right? You just get to watch your neighbors eat. So therefore, if the share of budget carriers goes up, it doesn't really benefit sets. So and the nearer term concern for us and this year is that from April this year, they start to consolidate the acquisition of WFS. So we are all putting our eyes, watching very closely how that will affect their balance sheet, how the WFS additional interest costs will hit the bottom line of sets. Also, there's a potential of amortization of intangible assets which they have, which they paid a premium for the acquisition of WFS. So we are very cautious of the outlook for sets, therefore a neutral call. The only positive coming through for sets is they have 3 kitchens in China, and these kitchens are ramping up because of the opening up of the China markets. But those are still at associates level. The main core business is still the Singapore, what they generate from the Singapore market. So our target price is $2.51. I'll pass it on to Meow Meow to talk about Sasseur. Thank you very much.
Thank you, Peggy. So we initiated Sasseur Reit last month with a buy recommendation and target price of $0.9. Sasseur is a retail REIT with all assets in China and is one of the biggest outlet mall player in the industry. Sasseur has a very diversified tenant mix with domestic fashion brands contributing to 43.2% of the total sales. And they also have like the regular international luxury brands such as Gucci, Coach, and Armani, which accounted for 19.1%. We would like to highlight 2 investment merits of the REIT. Firstly, is a stable income base. Backed by a strong sponsor, Sasseur has implemented the income model, which consists of the fixed component with 3% annual rental escalation and a variable component pegged to the tenant sales. In FY22, fixed component accounted for more than 70% of the total revenue. And we also expect the fixed component alone this year to generate dividend yield of 6%, which is more than the average of the STS stocks. Secondly, Sasseur is able to capture the upside through the variable component, leveraging on the robust consumption in China. Tenant sales at portfolio level were already up 17.9% year-on-year in the first quarter FY23 due to the pent-up demand and successful promotional events. We also observed that there's a shift in consumer preferences towards becoming more budget conscious, and there's growing number of middle-income families in China. Therefore, we believe post-COVID, the outlet mall concept will be more favored by the Chinese consumers. And tenant sales pre-pandemic were already growing at 12% year-on-year. And with the normalization post-COVID and the pickup in consumption, sales in FY23 is expected to increase by 25% and also translating into 10% of the dividend yield. Yeah, that's all for me. I'll hand over back to Zhang for the technical pause.
Thanks, Mel. I'll go through the outlook of the Singapore market. So for Singapore market, we'll be looking at this ES3 ETF. So this is the weekly chart. It has been making it has made a lower high into the uptrend support in May. So we can see that because of chart wise, it's still respecting this uptrend support line, but the rebound is looks to have weakened over here. And there's some resistance over here around the 3.3 level. So with that, we expect in third quarter for this ETF, we still could be trading in a bit of a range. So with that, we still have a target of about 3.13 to 3.33. In terms of large cap pick will be Yangtze Shipbuilding, as I have covered in earlier on, so I won't be repeating it. For mid cap pick wise, we have Delphi. So Delphi is chocolate confectionery business. So for this, there's a potential bullish track breakout. So the share price has been consolidating in this wedge for about 2 months, following the ascending triangle breakout that took place in May this year. So with that, if the share price does break out this wedge, we could see maybe it hit towards a 165 level. We take the height of these bullish tracks around 33 cents and project it onto a breakout point over here. Yeah, so that's all from me. I'll pass back the time to Paul.
Yep. Okay. Thanks, Zin. I think your camera is a bit out. So anyway, just to conclude, when we did our strategy, I mean, the few things that we tried to, in terms of the macro picture, is that we think the inflation is going to be quite sticky because a lot of it is core inflation dependent on labor, and this will just keep interest rates higher for longer, and that's why growth we think will be slower for longer. Some of the sweet spots that we think is the hospitality in China. We think, especially there's going to be a stimulus, but when we look at the Chinese consumer data, it's not as high as expectations, but I think we're still growing year on year, especially with the reopening in the background. Singapore economy is still in shape, and for us, we have we're more defensive this time, so we are more looking at dividends just to shelter out as growth continues to slow. So with that, I think we'll just move on to some of the Q&As. Thanks.
Okay, I think I'll take a couple of questions here. For the US side, there's one question on Meta's current price. It says here Meta's current price is so much higher than your TP. Why is your recommendation not sell? Yeah, so unfortunately, we don't actually do any. We tend to not really do any adjustments mid-quarter. So when we actually issued this target price, it was after their first quarter earnings call. I believe the stock price was somewhere around like 230, 235 range. Since then, there've been quite a lot of I guess positive news for Meta, like TikTok maybe being banned in the US, or even their latest rollout of Threads. And so we don't necessarily feel, I guess, the need to put a sell right now, because imagine earnings is coming out in a couple of weeks, we put a sell, and then for example, if there was something positive with earnings and then we readjust it back up, so then it'll be like you just keep moving the recommendation, which we feel probably isn't really that justifiable. But of course, it's also very difficult because the share price of a lot of companies in the US has actually run quite a lot. I think for Meta, they're up like 50% this year, so it's quite a significant run. But of course, our target price is also a 1-year target price. Yeah, so that's, I guess, a long answer of why we don't actually put a recommendation to sell at this point in time. There are only very rare instances where we would do a mid-quarter update or intra-quarter update, and we actually did one in the first quarter of this year after they announced their significant cuts in headcount. So that really impacted a lot of their OPEX for the year, and so we felt a need to actually adjust the target price upwards because of that. Yeah. Then there's another question here on. Let me see. There's another question here on if the stock is listed as a stock price, shouldn't its recommendation be accumulate or buy or maybe sell to take profit. But there are neutral recommendations under the US stock picks. So just to confirm if my understanding of stock pick is correct. Yeah, so for the US side, actually, we kind of just wanted to showcase kind of our firstly big tech, because a lot of people want to know about big tech, and secondly just kind of what kind of companies we are covering. I guess I forgot to conclude the US portion. In terms of stock picks, we really like actually your three companies that we really like are Google, NVIDIA, and Microsoft actually, and to a smaller extent we do also like Salesforce. For Google is mainly because of the AI hype plus the recovery in digital advertising, or the potential recovery in digital advertising, because they are the main leader. For NVIDIA, because GPUs for AI, right, it's really going to drive growth for the next year or two or so, or at least it's going to have constant revenue growth. For Microsoft, because like Ambrish mentioned, cloud is doing well. At the same time, productivity software is also kind of a mainstay for corporate, so it's not really so dependent on consumer demand. And then for CRM, I guess for CRM, it's mainly because of a lot of the AI kind of improvements in their products, where they're able to integrate a lot of the APIs with other corporates. So essentially to make the sales channel a little bit easier. Yeah, so I hope this clarifies a little bit on your question. Let me see if there's any more. Yeah, I think that's it. I think I'll hand it back to the rest of my colleagues to answer the rest of the questions. Thank you.
Yeah. Oh, okay. So
yeah.
let me just take on this admin thing first. Is this session 11 a.m. weekly meant to be for? Okay, we should usually try to conclude the presentation by 11, but because once there are usually lots of questions, then we will just try to address all the questions. That's why it will run, and we will try to do a hard stop by 1 p.m. So maybe it's not that clear for everyone, so apologies for that, but that's generally what we typically do. Yeah. I hand it back to you, Darren.
Yeah, thanks, Paul. Okay, so there's one question on what are your views on Parkway Life REIT fundamentally and technically. Yeah, so for the technical part, of course, I'll leave it to Zain. But for fundamental part, Parkway Life REIT is still trading at their own, they're like trading at their own valuations. Like what I mean is because they're trading at 1.5 times, and historically they're always trading around these high levels as compared to the other REITs that are trading at 1 times book. So the Parkway Life, but one thing about them, I mean, we don't cover Parkway Life, but one thing about them is that they have this Mount E Hospital AEI that's ongoing. They call it Project Renaissance. Yeah, so in the near term, there won't be much rental growth for them, but this Project AEI will help to possibly boost their rental for Mount E Hospital by about 30 to 40% after 4 years. So that is one good thing. And then I guess for them, they're also always trying that with their inorganic growth strategy with nursing homes in Japan, because the interest rates are still low there, and it's the place where Japan is still the place where they can get a positive carry on their investment. Yeah, so we do not cover Parkway Life. So yeah, so I guess that's all I have to say about Parkway Life for the fundamental part. But yeah, the yield is also not the yield is not very high, so it's around 4% if I remember correctly. Yeah, okay, the next one is on CDL. What is the likelihood of the Fuji Xerox structure collapse on CDL in the midterm and the long term? Yeah, so this Fuji Xerox structure collapse, which is now called a Newport Residences, they kind of renamed it, and this structure collapse will because of that they have to stop work, and then it will delay the completion or the TOP date of this Newport Residences. But then this Newport Residences, to begin with, it was delayed. The project launch was delayed. So this probably delayed even further. And yeah, other than that, some of the probably the management might get some headwind, some backlash because of this because of the accident. Is quite unfortunate though. Yeah, and then the next part of the question is, do they enjoy recurring income fee streams like CLI? Yeah, so for CDL, they are trying to build up their recurring income streams with their recent PBSA acquisitions as well as their PRS, the private rented sector, their new segment that they are trying to get into. That is mainly in the UK first. So, but for CLI, their fee income is their recurring income stream is very stable. Like because they have listed and listed platforms under them, so they just collect this management fee. Is super sticky. So is that it will be there, and it's very stable. But for CDR, they do not have such funds under them, and they do not have this recurring fee that is so sticky. The most recurring stream that they have is this PRS and probably their commercial, the fund management sector, like some of the commercial assets that they own, like currently the ones in the UK and such. Yeah, so on a recurring fee income basis, CLI definitely has better recurring fee income than CDL. Yeah, hope that answers that question. The next one is FCT. To what extent will Singapore Next be consolidated or profits flow through to the bottom line of FCT? Yeah, so just some background. FCT, they acquired Next together with their sponsor through an investment vehicle. So both FCT, Frasers Properties, and FCT, they own 50%. So of that 50%, FCT owns 51%. So that translates to about 25.5% ownership of Next for FCT. So because it's not 50% or above, the FCT, they do not consolidate these profits, or rather they do not consolidate the profits into their financial statements, but it's they're equity accounted, so it's a one-line item. So it's under profits from JV. So it will be at the bottom line. It's just one line of the profits. Yeah, so in that sense, it will still flow through to the bottom line of FCT, but it's not from the top line revenue. Is equity accounted, like one line item, share of profits from JV. The next one is, hi, Darren, given the mega concerts that will be held in Singapore next year, are you positive on the revenue of hospitality REITs going forward, considering that these concerts may attract their fans to travel here and to attend? Yeah, definitely. So just some quick calculations. The F1 in 2022 last year, it attracted about 302,000 people to attend. And then next year, these two mega concerts, Coldplay and Taylor Swift, both also will have 300,000, around the same number, like 300,000, because National Stadium, the capacity is 50,000. And then 6 nights are performing each, so that's 300,000. I mean, that is if you consider everybody only attend once. I mean, there are some people who are hardcore fans that may attend more, but then we just don't count that. So let's say if we just take it 300,000, and then let's say 30% of them are foreigners. So that is about 100,000 for both Coldplay and Taylor Swift, and there will be 100,000 in possible demand for for hotels and these service residences in the next quarter. I mean, in the first quarter of 2024. Yeah, so we expect the RevPAR in Singapore, because of these two mega concerts, to be very high next quarter, and probably you will not see any seasonal weakness because of these two mega concerts. And as a follow-up question, I think on FEHT. So what is your view on FEHT? So because of these mega concerts, FEHT, they have 100% of their assets in Singapore. So they are like a full beneficiary of these mega concerts. So we are quite we think FEHT will do very well also because of the increase in RevPAR and due to the concerts as well. Like we see some news outlets saying that it's really the bookings, the search for the bookings have already increased like 8 over times, and the ADRs also are expected to increase like minimum 30% from the usual first half, or rather the first quarter in considering there's no concerts. Yeah, so we are very bullish in this sector. Please suggest Indonesian REITs with good yield and upside. Yeah, so we do not cover any Indonesian REITs, but for Singapore listed REITs with Indonesian assets, I can think of two, Lipo and First REIT. So Lipo, we all know that they did not pay their perps, their perpetual bonds, the coupon. So because of that, they were not able to pay dividends. So yeah, they are in financial distress. If there's a word to use. But for First REIT, it's a better story because they have hospitality assets not hospitality. They have hospitals in Indonesia, and they also have nursing homes in Japan. So First REIT, they had an issue 2 years back when their sponsor had some issues. But then since they kind of re-signed or restructured their lease, their lease terms are now looking much better. Yeah, I could go into detail, but that's a long story. But basically, more of the contribution is coming from Siloam rather than Lipo. So because of that, there is more kind of is less risky for their rental collections. Yeah, so with us, I think probably First REIT might be a good pick. Yeah. Yeah, I think that's all for me for now. I think I'll hand over to the rest of my colleagues. Thanks.
Let me do there's one question on SIA. Okay, the question is, hi Peggy, you make a most compelling case for SIA. What is the thing that needs to happen in order to improve the target price valuations? For example, raise ticket prices, lower debt, etc. Okay, I come up with a list of things that I hope that could help improve the SIA share price. Okay, but some of these could border on speculation. So I think the listener have to take this with a pinch of salt here. Okay, we think we will be much encouraged if we see that the Vistara and Air India merger is put on hold. What doesn't happen right now? It's being put on hold for antitrust decision because Vistara, since they invested since 2013, has never made a single cent has never made a profit. So over the years, up to September last year, they wrote off all their investment in Vistara. So it was quite a relief for analysts. So we don't have to guess how much loss they're going to make again for SIA going forward. But now that the merger, after they announced the merger, they're going to write back all these losses that they had written off last time. So it looks like there will be a gain for SIA, but it's nothing to cheer about, because if the merged entity continue to make losses, then every year the ghost will come back again, and then there's nightmare for analysts like us. The second thing is if there's some component shortages for some aircraft parts right now, especially I heard is some kind of thing relating to engines. So if the component shortages might impair the ability for the competing carriers to bring back the capacity as quickly as they want to. Another so-called positive for SIA is if the competing carriers they don't have the blessings like SIA had. SIA had 22.4 billion of cash being poured them since April 2020 when COVID hit. So they were able to run faster and and start the race, finish the race ahead of everybody else. So just a comparative, the Cathay Pacific received the same amount, but it is in Hong Kong dollars. So you see that SIA has a six times better chance than Cathay in that sense. So if the competing carriers have weaker balance sheet, they might means that it's slower for them to come back to return back to the original capacity. But having said that, you also notice that the Chinese carriers, they did fundraising early this year by placing out new shares, and those were very well absorbed. So this scenario will probably not happen to the Chinese carriers. So and also you're supposed to love your neighbors. You don't curse your neighbors in that sense. So these two might or might not happen. And then another possibility is this is really speculation, right? I don't know anything about this. I'm just thinking a lot, right? If they were to spin off SIA Engineering, and then before that take out the cash from SIA Engineering, there's about 630 million net cash in SIA Engineering that goes into, if it goes back to SIA, SIA owns about 70% of SIA Engineering. If they are able to get 70% of this 630 million, that will help their balance sheet, and that potentially could mean an improvement in the cash flow. Then on the DCF basis, there's room to improve the target price. Okay, again, I qualify all this. The above points that I just mentioned are all just pure speculation. I cannot say whether they will happen or not. Right. Thank you very much.
There's some questions on the chat also.
Okay. I'm not sure whether this is a technical question though. It says C-train pull back today with high volume.
Yeah. Sorry. Yeah.
Is it good time to collect?
Yeah, we leave it to
and
Zane.
Semcop also. Yeah. Okay. Thanks. I pass back on to maybe Glenn.
Yep. Thanks, Peggy. Yeah, so I'll take on the banking question first. Hold on, let me find it. Oh yeah, okay. So the question is, any comment on SG banks in the later half of 2023? Yeah, so good question. Yeah, I'll just reiterate my points, mainly being that the net for all three banks. Okay, let's say the net interest margins will sort of has peaked, right? At least in the first quarter, and even the banks are also guiding for it to sort of slowly normalize back to a lower, but still very high. So they are expecting it to be at least above 2% for the rest of the year. And we should sort of see this in the second quarter results, which will be coming up shortly. And for the rest of the year, it's also going to stagnate a bit. But if you look at a full year 2022 compared to 2023, there will still be quite a big improvement. And so that's a good thing. So the next point is the loans growth. They are also expecting loans growth to moderate, and it will be quite low this year. For the full year is looking somewhere between the low to mid, low single digit for loans growth for the full year of 2023, and I think it will come in close to that. It might even be flat loans growth for the year. And how this will affect their net interest income is that it should still continue to climb, and they should still be able to sort of show growth year on year, but they might not be able to reach that sort of record net interest income for the rest of the year. But if you look at a full year perspective, I think it will still be able to reach very, very high levels. So, I think the second one would be their fee income. So these two are the main revenue contributors for them, the net interest income and the fee income. Fee income growth is recovering very well. In the first quarter, we saw that for the first time in about 4 to 6 quarters, we saw an increase in quarter-on-quarter increase in fee income. And I think moving on to the next few quarters, we should continue to see this growth. And in a year-on-year basis, I think it'll be a close to a double-digit fee income recovery for all three banks. And so this will be the main sort of growth driver for the three local banks. And I think so one more important thing which I spoke about on OCBC earlier was that their dividends. So all three, DBS has been the most forward with this, and they have come out to say that, oh, we are going to increase the dividends by 24 cents annually for the near future, and they have not mentioned whether they will stop this. And for UOB, they increased their dividends, so we would like to see what will happen, whether they will match DBS to increase it they only release it every half yearly. So this first half and second quarter, which should be quite interesting. And for OCBC, we are also expecting it they should be able to increase their dividends, because they have, as I mentioned earlier, they have very high CET1 levels. Yeah, so I think that's I've covered the three points for the banks. Hopefully that answers your question. Thanks. I'll hand it over to the rest of my colleagues. Thanks.
Let me take on the question on cloud. Who is the dominating cloud service market share? Any differentiation of dominance between geographic region? Does this mean that key player will continue to maintain its dominance position and preventing the new entry? So basically, in the global market, global cloud market, AWS is the dominant player with a market share of about 33%, and Azure, it has a market share of about 23%, and it has doubled over the last 5 years. And Google Cloud, it's the third largest player with a market share of about 11%. And we believe that in terms of geographies, there is not much significant difference. These are the three large players. However, in China, they don't have much significant presence. And in China, it's the Alibaba Cloud who is the market leader with a market share of about 36%. And the rest cloud players in China would be Huawei as well as Tencent. So considering the financial stability and the large scale of these three cloud players, I believe that this should limit competition going forward. So that's all for cloud. I would now like to pass on to the rest of my team.
I'll answer the question for Sasseur. On Sasseur as a stock pick, we are curious if this is part of the initiatives to extend stock coverage to lesser known names. It's yes and no. As part of the initiatives to extend stock coverage, but it's more like we would like to capture China's recovery play, as one of the investment thesis is like the robust consumption in China. Like I just mentioned, retail sales in first quarter increased by 80% year-on-year. Yeah, and Sasseur is 6%. Is it after withholding tax? Yeah, it is after withholding tax. Standard dividend withholding tax in China is 10%, and company income tax is really 25%. So historically, the tax as percentage of total return before tax is around 23 to 29%. Yeah, and 6% is after the withholding tax. Yeah, that's all for me.
Okay, thanks. Before I hand it over, I'll just try and clear whatever questions that we have. May I know where I can find the recorded session for Saturday's stock picks and strategy? For all our videos, even for the usual 11 a.m, we will put it in the YouTube channel for PhillipCapital. You can also find it in our P3 community app, and also for Saturday, some of the questions that were given to us, we will try to answer them through the community, through the P3 community. Next one, Paul Chia on the Marine ComfortDelGro. Yeah, okay, okay. Anyway, just for a separate update, we'll probably you can listen to them. So they only do, I think, once a year or twice a year. They will do a webinar for retail clients. I mean, for institution, of course, most of these listed companies do, but for retail, they'll probably do one with us in September, so you can ask them more questions if you on this marriage thing. But anyway, September they will be doing a webinar with us. We're just trying to iron out the dates, and then do watch out for that. The next one is how is the recession signal for the US side now? Okay, there are a few recession probability indicators. So there's one that comes out from the New York Fed. I think you can even Google it yourself. But that is quite elevated. It's about, I think, 60% to 70% now for recession to occur in June 2024. they use the yield curve a lot. Just as for context, when they did it for the global financial crisis, the probability is about 40%. So right now it seems a bit very elevated, but they're very heavily reliant on the yield curve to compute whether the probability of recession. But that's the latest data. If you want to have a data set now, that's the number that comes out from the New York Fed. Okay, this one for Darren, I think, yeah. Hi, Paul, do you think the current TB, SSB rates are expected to climb further before falling? There's after next year and hopefully Fed funds rate. A Treasury bill, I think, yeah. My guess is it's probably going to peak. I think it's more or less very close to peaking. I don't think it can climb up anymore, especially after the recent inflation number. So I think one more rate hike, then you think that the Fed won't. So there's a July meeting, then there's a September meeting. We think with the July meeting, they won't say they will pause. I think it will be a bit early, but the September meeting, you probably see a clearer direction whether they will pause. We think there's a good chance because core inflation, which is very dependent on shelter now, because if you look at the latest inflation number, the reason why it dropped so much is because energy prices, which is oil price, dropped almost 18%. And next month you should also see inflation drop even more, because if you look at the fuel pump price in the US, July fuel price, that is the gasoline, which is the gasoline, the one that the retail gasoline price, also down about 18. So I think inflation headline will still continue to drop. Shelter may not drop that much yet, but because the base, if last year it climbed up, especially in the fourth quarter, so you probably see there's a good chance that we could be one more hike, and that's it. So I think maybe we think SSB may not even climb anymore. It might be actually stalling now, because if they take the gauge from the Fed rate, because everybody knows there's a 90% probability of a rate hike. So the rate hike is probably already priced in by the current SSB and TB, my own guess. Yeah. Because the futures market is pricing a 90% chance of a rate hike on the 26th of July next week. Okay, okay. I'll try to take this last one, then move on to technicals. What's the view on HR net? The volume is low and the price was extended. Can they maintain dividends? We think they can maintain. It's just whether they want to maintain, because they have like 300 million net cash right now. They are to maintain the current dividends is probably, I think, 40 million. We think earnings might be a bit weaker this year, so they could still make like 50 million. So they can maintain is whether they want to, because they have like 300 million net cash, and the business, as you know, don't really need any cash. It's like only 2 million of fixed assets, which is basically like 2 Mercedes-Benz. That's it. They don't, most of it, they just, the one thing we like is just the model, it spews out a lot of cash, but just that in the near term, we think we're expecting some weakness in the earnings. Okay, I think thanks for all these questions for the fundamental. I think I hand over to Zain for the technicals. Zain, over to you.
Okay, thanks, Paul. Let me just share my screen right now. Okay, I think I'll go through some of the questions in the chat first. First one, Centrepoint pullback today with high volume. Is it a good time to collect more? I think for now, since it had went up quite a fair bit over just a few days last week, could be seeing a little bit of pullback. Yes. I think a good level to try and accumulate more could be around closer to 13.8 cents, which was a previous resistance level over here. So over here, if you do back test, it could become a short-term support. So it could be some sort of a good support in this current uptrend, in my opinion. Next one is, what's your view for Sembcorp ups and downs for the last 2 weeks? Will you move up again? Okay, for Sembcorp wise, I think currently, yes, it's been trending quite in a range. Currently, it's still holding above this trend line over here. So this has still acted as a support. And the resistance quite clear around 580. So for now, momentum is still rather down. So I think for now, there's a chance that it could still go up to test the resistance again if you do continue trade in the range pattern. As long the recent lows, I think around the 510 to 515 level is able to hold, then we would have formed a higher low currently, and it could possibly go and test the upside resistance again. Next one will be, what's your view on Food Empire? Is it still uptrend? Food Empire is still very strong. There was a long period of consolidation that took place, and I think I mentioned 1 week ago, there was a break above this 106 resistance after a very long time. So then we saw price broke out towards the upside. Also managed to break above the 113 swing high over here. So for now, yes, Food Empire still very strong, and I think for now still is a very nice gentle uptrend over here. So I think definitely still in uptrend, and yeah. And next one will be, what's your view for ComfortDelGro? A bit slow. You think can climb back to 2+? With ComfortDelGro, I think 2+ is still very far away. So I just focus on the current what's happening currently. Currently, some good signs. It managed to stand above this previous resistance at around 117, 118, as well as around 120 over here. So over here, this was a previous very stubborn resistance. We saw some sideways consolidation before trying to break above. So with that, could have still some further upside if we do manage to hold this previous resistance as support. Next near-term resistance could be around 120, 125 to about 130 levels over here. Yeah. So I think for now still trending well upwards, but to hit $2 we need a lot more effort. Yeah. Okay, then I'll move on to the Q&A. There's a question on Keppel Corp. Okay, for Keppel Corp, currently there's the uptrend, the support line over here that's still holding over here around 655, and price managed to break above this key level around. Sorry, there was an uptrend support line around 637. Then price managed to break back above 655 over here. Also a short-term downtrend resistance line. So if that managed to test this small resistance around 675 to about 683 over here. So over here, should price able to stand over here, that should be able to try to climb up a bit further to maybe 690 to about 7 over here. But if here it meets some resistance over here, it could come back a little bit down to test the recent support close to 655 to 660 over here. There's some counters for US, Amazon, Microsoft, as NVIDIA. So for Amazon wise, Amazon, there was a still trending well. It has been consolidating a range, and then once up during the back test, previous resistance able to turn to support around 127, and then last week we broke above this 130, 131 resistance. So currently tested 136, which was a previous swing high over here. So for now, could meet some form of a resistance. Should we pull back? I think could retest 131 for some good support again, as it has done previously over here. And then we see whether it can form a nice crossover on MACD over again. Yeah, but the uptrend is still holding for Amazon. Okay, for Microsoft, there was a retest of the recent highs around 351 over here, and then it was met with a bearish candlestick on Friday. So some resistance still acting over here, but I think there was a period of a long sideways over here where the resistance was around 340 to about 343. So over here, I think upon a back test, we should be able to find some support, at least in the short term. Then I see whether you're able to attempt the highs over here again for Microsoft. Yeah, so for Microsoft, the uptrend is still intact over here. And then for NVIDIA currently, some resistance over here, this upper trend line over here was around 460. So with a shooting star candle on Friday with high volume, so some profit taking. With that, if you do see a little bit of a pullback, could see maybe a retest of the recent resistance about 440. Over there, could see maybe some short-term bounce also. Then we'll have this uptrend support line over here as well. And for Delphi, okay, managed to break out today over here. So as I covered just now in my slide, consolidation breakout over here. First level of resistance in the very short term could be around 135, so about 130 over here, 135. This swing high as well as the previous support that was broken down. So if you do clear this, the next resistance could be around 144, this swing high over here. Then hopefully you can see 165. That's the project target. And Mapletree Logistics Trust. Mapletree Logistics currently, I think, still very much range bound. Price supported around 162, but I think resistance is coming in around 172 to 174 over here. So likely, I think we'll still trade in a range for now. But some bullish momentum picking up in terms of the MACD, higher lows being formed. So we see whether there's a chance for a breakout above this resistance in the time to come. And then Keppel Pacific Oak Reit. Price is still sideways over here after hitting the resistance around 34 cents. So for now, see whether you're able to hold up here. If it does, then it could potentially go out to test the next resistance level closer to 35.5 cents to about 36 cents over here. If not, it will just come back, maybe come back down to retest about 31.5 cents. This resistance that we broke out. And then for SI Engineering, I think not much that has taken place, still trading an uptrend channel over here. So for now, immediate support will be probably around 1245, this swing low as well as the channel support over here. And in terms of MACD wise, I think currently it's looks like it's a bit of consolidation also with the low volume. So we see whether some support can be found over here if it does reach there and try to test the upside again closer to 250 onwards. And then CLI, I think it's okay. Previously there was a downtrend channel over here. There was a breakout took place on Thursday. Currently looks like a back test to see whether we're able to hold this level around 339, 340. MACD also trending upwards in the recent downwards price action, so some bullish divergence. So if price is able to hold at this level, could potentially bounce higher to maybe test the next resistance around 350 to about 352 over here. Next one, OUE commercial rates. I think for this, it's very much range bound over here in this stretch since September of last year. So the support is around close to 30 cents, 31 cents. Resistance you see about 33.5 cents onwards. So for now, I think in terms of the TA, nothing much unless we do see a break above on the highs over 34.5 cents over here, or the break over the lows recently around the 30 cents mark. If not, I think continue to trade in the range for now. And then for prime US REITs, prime after breaking this blue color trend line over here, price just sideways over here. But positive thing is that over here in this stretch, we see that it forms higher lows. So the buyers are willing to buy at higher prices over here, currently support around 21 cents, 21.5 cents. So I think there's still some good chance if we do see a break above the 23 cents, could potentially bring price upwards towards 25 cents things, but still in a sideways mode for now. Okay, then for Genting Sing, there was a break above this wedge. Currently looks like a bit of a retest at around 94 cents. So if you're able to hold this as a support, given that it was this resistance start of last week, if you want to turn the support, I think could hit a bit higher to maybe retest some next near-term resistance around 97 cents to about 98 cents over here. As for First Resources, currently, I think it's could see a little bit of a pullback for now. Since that after the rebound that took place over here, currently enter into the resistance area. We have this downtrend resistance line, also these swing highs around 153, 112, which has hit. So for now, could see a little bit of pullback, maybe retest some near-term support around 143 to about 146, this area over here. And then for sets, okay, sets after a period of price being sideways after downward movement, managed to break above this resistance at around 262, 263. Price retested these trend lines. Resistance around 270 currently. I think we still need more confirmation to see whether some resistance or whether it can hold up here for some further upside. So if price trends downwards again, likely to do a retest for some support. If it goes upwards, I think the next resistance it could go and hit is closer to about 280, which is this swing high over here with high volume, as well as the previous, there was this small range that took place before a breakdown. So this will be a key level for sets around 280. Then Q&M. On Q&M, there was looks like price is trying to get out of this long-term downwards resistance line. This was all the way back since November 2021. Okay, price just, but still sideways over here, resistance at 30 cents, also a previous support. So if it does able to break out, the next level to look out for is around 31.5 cents. Also this previous support over here. Yeah, if you manage to break outwards, then there could be some sign of price trying to change to do a trend reversal over here. Okay, then for Jaffa, I think currently nothing much, still trading in this very big range over here. So resistance still around 24 cents to about 24.5 cents. Current support is about 22 cents over here. So I think still will continue the range trade unless we see a break upwards of this current range or breakdowns. Okay, next one will be SIFMAC. Okay, SIFMAC currently still trending well. There was a break above this wedge took place last Wednesday. Price is just trending upwards still. So I think upwards momentum is still quite strong over here. As you can see, there was a push and there was a break, and then there was a breakout following the next day. So this pattern has just been continuing, which shows very strong buying activity. With that, let's see whether there's a next level. Looking at the weekly chart, the next key resistance could be around 86 cents. So previously, it was like the last support point over here before price broke down over here. So over here, if it does retest, could be the next resistance level. But currently it already retest over here. So yeah, currently there could be some form of resistance at this level over here. And support wise would likely be a back test of around 79 cents, which is this wedge breakout over here. Okay, CICT next. CICT price has managed to get back above this trend line over here, which is around 191 after finding support at this trend line over here. So could be trading very much in this expanding wedge over here. So currently I think we have met some resistance at 198. So with this trend line resistance as well as this previous support that broke down over here, likely find some resistance, could see a little bit of a pullback this week to retest a good support around 192, 183 over here, which is this trend line as well as recent resistance that we managed to clear over here. Now move on to Propnex. Okay, Propnex currently I think be interesting. Very in this main uptrend channel. Currently resting at the channel support over here around 99 cents. Price tried to break below this support, but subsequently recovered above very quickly. So if the buyers are able to hold over here and looking at MACD wise, it's able to turn green crossover above the zero line, will represent some short-term wave up again if buyers are able to hold at this level. So still need more signs to see. If this doesn't hold, likely we could retest the lows around 97 cents again, but it's very likely to be a very tight range over here for now. Okay, then I'll go through the three banks. Okay, so for DBS currently, looks like it broke above this range over here. So if it's able to hold above the 3190, price could try to maybe retest the swing high around some resistance at around 3260 to about 3280 over here. Okay, then for OCBC wise, okay, price also recover back above this 1210 level. So that some short-term resistance over here, there was a bit of a range form and the highs was around 1240, 1240 to about 1250, some resistance short-term wise. If it's able to clear, then likely it will be around 1260 next. And then next for UOB, UOB retested some previous support around 2780, 2790. So let's see whether price is able to hold at this area. If it's able to do so, it could potentially rebound back to try to hit some of the higher resistance around 2830, 2840. But if it can't, likely could trend to try and if it doesn't, then it could come down to test the lows around 2720 to about 2740 over again. So in terms of the three local banks, some recovery in terms of the share price. Yeah, but we still need to see whether it's able to hold over there since the recently some of the share prices can be quite volatile, and I see some false breaks that could take place. And maybe I'll just go through two more since that it's about close to one. Broadcom initial break, there was a potential breakout above this wedge over here. So price action wise, still sideways for now a bit. If it's able to hold this previous resistance level about 877, 880 over here, try to do a bit of a range too, then could potentially go upwards to test the next resistance at 916 over here. And then last one for Baba. For Alibaba, currently it managed to form a higher high over here. We tested about 94 to $95 previous. There was a previous support that was broken down over here. So over here likely to be a retest for now. Some resistance could be coming. But if as long price continue to form a higher low, then the uptrend over here in this stretch could continue over here. So currently some support could be coming around 88 to about 89 over here in the short term. Yeah, so that's all from me today. You can post your questions on the P3 community. Apologies in view of time, I couldn't answer all the questions today. Yeah, so that's all from me. I'll pass back my time to the rest of my colleagues.
Yeah. Thanks, Zane. So I know there are a lot more questions. Feel free to type it in our P3 community. There's one question on the replay. So the replay is always in our YouTube, PhillipCapital website on YouTube. So feel free to also look at that if you wish to hear any particular parts. With that, I'd like to thank everyone for your time. Hope you have a good week ahead, and thanks again for your participation and especially for all your questions. Thank you, everybody.